Welcome back to another video. In the last video, as we're talking about investments, I wanted to introduce you to some types of investments. So you learned a little bit about what is a stock, what is a bond, what is a mutual fund, and what is an ETF. So I want to just kind of highlight that, and we'll talk about this again in our Zoom meeting this week, but a stock is a type of investment. But there's also something called an asset class. And I want you to understand and be able to distinguish the difference between an asset class and a type of investment. So a stock is a type of investment. You buy a stock in an individual company. You can also buy an ETF. Now, an ETF is a type of investment. A stock is also an asset class. So large cap stock, small cap, mid cap, those are all asset classes. So it's a little confusing, but we'll talk about it again. And I want you just to understand that when we talk about a specific type of investment, that's one thing. Type of investment, you can invest in a stock, you can invest in a mutual fund, you can invest in a bond, you can invest in an ETF, but that's different than an asset class. So a stock and a bond, those are asset classes. And that's why it's a little confusing to say that a stock is an asset class and it's also a type of investment. A bond is also a type of investment. You can invest in a bond, but it's also considered an asset class. So stocks, bonds, cash, those are asset classes. So think about investments and risk in investments in terms of asset classes. That will help. And also you need to understand the difference between types of investments, which is why I introduced you to what is a mutual fund, what is an ETF, what is a bond. So as you start to build your knowledge about investing, you need to understand different types of investments. And you also need to understand types of asset classes. That's really important because we're going to talk about asset allocation. Asset allocation is the single most important determinant of your portfolio's returns. So to understand asset allocation, you really need to understand what is an asset class. What is a different asset class? Stocks, bonds, large cap stocks, small cap stocks. And again, we're going to talk about this again in our Tuesday Zoom meeting. But today in this video, we're going to cover a little bit about time horizon, liquid assets, cash and cash equivalents, and what is a money market fund. And again, Tuesday in our Zoom meeting, we'll wrap up with the 4 investment strategies. So I hope this video helps. We're going to use Investopedia, some short clips that we got from Investopedia to illustrate some of these types of assets. So not so much types of investments this time, but types of assets, asset classes. So hope you enjoy the video. I'll see you in the next one. When you consider investment strategies, you have to start with risk. So let's take a look at an introduction to risk, understanding risk in time horizon.
Risk is something that most investors try to avoid. The riskier the stock is, the more return there should be to compensate for taking on that risk. Risk in investing is measured by something called standard deviation. It is a measure of how much the stock price swings high and low compared to its average price. A low-risk stock will have small swings and therefore be more predictable, but a risky stock is unpredictable with larger swings. Risky stocks can be profitable as long as you get out during a high, but sometimes you're forced to take out during a low, and this is when you need to consider your time horizon. Time horizon is the length of time you can part with your money before you need it again. If you have a long time horizon, you can wait out any large dips, so you can have more risky investments. But if you plan on taking out your money within the next year, you would have a short time horizon, and you might be forced to withdraw during a dip. The shorter the time you have, the less risk you can take. This is why your financial advisor needs to know your time horizon before they can choose the right investment.
A liquid asset is not a reference to a collector's bottle of fine wine. Ironically, a collector's bottle of wine is actually considered an illiquid asset because it's relatively difficult to quickly sell for cash. So what is a liquid asset? Something you own that is easily converted to cash. The easier it is to convert the asset, the more liquid it's considered. Common liquid assets include currencies and commodities, as well as debt and equity traded in major exchanges, like the New York Stock Exchange and NASDAQ. Common illiquid assets include art, collectibles, and antiques, as well as debt and equity from private, non-exchange traded companies. Another aspect of liquidity deals with how price is affected by the conversion to cash. If the asset's price drops when quickly converted to cash, that's another indication that the asset is not liquid. This is where readily available markets come into play. If there is a market for the asset, then an owner can easily sell the asset with little effect on the sales price. Stocks, bonds, and money market instruments are examples of assets that have a readily available market. Investors can buy and sell these assets on an exchange and have very little, if any, influence on the price. As securities or investments, liquid assets pay a lower yield than illiquid assets. This is because investors require a higher return on an illiquid asset due to the increased difficulty of selling it for cash. Consider the example of investor Rocky Waterman. Mr. Waterman owns 2 government bonds, each with a face value of $500,000. The first bond is a U.S. government treasury bond that Mr. Waterman can sell on the open market. The second bond was issued by a developing country called Freezonia. Freezonia's bonds are not traded on any market. Mr. Waterman, being the smart investor that he is willing to accept a current market rate of 2.78% on the U.S. government bond. But because he will have difficulty selling the Freezonia bond, its rate is much higher, at 5.62%. In this scenario, the U.S. government bond is considered a liquid asset, while the Freezonia bond is not. Cash and cash equivalents are items on a company's balance sheet that are either physical currency or liquid investments that can be immediately converted into cash. Examples include bank accounts, marketable securities with short-term maturities, treasury bills, and money market funds. They are unrestricted, meaning they can be turned into cash with little trouble or delay. Unlike investments such as stock, cash and cash equivalents don't typically change in value very much. They represent a company's liquidity and reveal aspects of a company's operational strategy, both important details for potential investors to consider. Companies use cash to pay debts. The more cash a business has on hand, the less likely it is to struggle to pay its short-term liabilities or to have difficulty staying afloat when sales slow. But it's also important to remember that a company with large amounts of cash on hand may be missing out on the money it could make by investing that cash. Money markets are safe, liquid investments that are well suited to the small investor. They typically invest in steady funds, such as treasury bills and commercial paper. George is a recent college graduate who wants to save up for a trip to Europe in 12 months. Because his time horizon is short, he chooses to invest his savings in a money market fund. Money market funds are short-term, so funds are invested for a limited period of time. Treasury funds and commercial paper funds last an average of 1 year or less and 270 days, respectively. If George needs his money from one of these accounts before the investment time has ended, many money market funds offer the option of selling the fund, usually for a smaller profit than if the money had stayed in the account until the term ended. Opening a money market account is as simple as opening a savings account with a few differences. The account usually requires a minimum balance to open and be maintained at, and you must leave your money in the account for a specific time period. While money market funds do not yield a huge return, they boast higher interest rates than most savings accounts and are more convenient for short-term investors. Strategic asset allocation is a portfolio strategy that involves setting target allocations for various asset classes, then periodically rebalancing the portfolio to maintain these original allocations. Allocations can deviate due to differing returns from various assets. Balanced diversification can reduce risk and improve portfolio returns. Strategic asset allocation is an investment strategy focused on the needs of the investor rather than the constant tracking of the markets, and is thought to remove the influence of emotion from investment strategies. Caroline recently opened a Roth IRA with $5,000. Because she wants to remain in the same investments long term, she decides to use strategic asset allocation. Caroline is 25, has a high risk tolerance, and doesn't plan to retire for at least 40 years, so she wants to allocate her portfolio 90% to stocks, $4,500, and 10% to bonds, $500. 1 year later, Caroline needs to rebalance her portfolio to maintain the original allocation of 90% stocks, 10% bonds. Why? Her stocks return 15% over the year, but her bonds return 2%. So her portfolio now consists of $5,175 in stocks, 91%, and $510 in bonds, 9%. She needs to sell $58.50 in stocks and purchase $58.50 in bonds to get back her original asset allocation. She will repeat this review of her allocations every year to maintain her desired percentages. As market returns change, as she gets closer to retirement, and if her risk tolerance changes, Caroline will have a different strategic asset allocation strategy, more bonds, less stock, and thus buy and sell different amounts. Dollar cost averaging is a more conservative approach to investing than simply spending all your money on securities at once. This technique allows investors to commit to a fixed dollar amount of a particular investment on a regular schedule, regardless of the share price. More shares will be bought when prices are lower, and fewer shares will be bought when prices are higher, resulting in a lower average cost per share. Dollar cost averaging reduces risks by allowing investors to ease into the market over time. For example, Chris buys $200 worth of stock in Billy Bob's restaurants each month for 4 months. In January, the value of the shares drops to $50 each, so he buys 4. In February, the stock is worth $40, so Chris buys 5. In March and April, he buys 8 shares of Billy Bob's, which dropped in price to $25. Overall, Chris purchased 25 shares at an average price of $32. If he had invested all of his money at the same time, then he would have only bought 16 for an average price of $50 per share.